Thank you all for showing up. I want to give my special thanks to Ed Greene for making time out of not just a busy life, but a frantic life these days at Citibank to come and talk to us today about sovereign wealth investment funds. Ed is currently the General Counsel of International Markets and Finance at Citibank. I've known Ed for well over a quarter of a century. He's been not only a friend during that period of time, but I can honestly say a great inspiration to my own career. He's an individual who's not only the real deal, he's the whole deal. He's civically engaged. He was I was head of the Division of Finance at the SEC, and then as General Counsel during one of the most formative periods of change. And he was the instrument for change in bringing the SEC so much into what many of us thought was then the 20th century, long overdue, and he gets full credit for that. The partner at Cleary Gottlieb, and for 14 of those years was the partner in the London office. During that whole period of time, he's been very generous with his time to both his law school and other law schools, and continuing programs to enrich various institutions. He was the chairman of the legal advisory board during its really critical years, I thought, at the New York Stock Exchange, time that I had the privilege of overlapping on the committee's membership. He talks about a subject today that I think is clearly is already and is going to be in the forefront of a national debate, and that is the significance of sovereign wealth investment funds, not only today, but as Ed will tell you, is a development that is growing exponentially. So, Ed, we're glad to have you here today. Ed would like to talk for about half an hour, and then be available for questions before we face ejection from this room because of the ongoing classroom coming in here. So, Ed, thanks. Welcome.
Thank you. I'm delighted to be here. Let me say that these are my own views and not those of Citigroup. But let me also say is when sovereign wealth funds invest $35 billion in your company in a 2-week period, you find that you get to know a bit about them. First, what are sovereign wealth funds? Treasury definition: government investment vehicles funded by foreign exchange assets and managed separately from official reserves. The point is, governments have massive foreign reserves today, which we'll talk about. Rather than have those all managed by the central bank in terms of maintaining currency exchange rates, some of these assets have been shifted to be managed separately to make investments to enhance the return for a variety of reasons. Now, they're not new. The first was in 1953 when Kuwait declared independence from the UK. The second was in 1956, involving an island that I had never heard about in the Pacific. It's spelled K-I-R-I-B-A-T-A, but it's pronounced differently, so I won't try. It had a great natural resource, bat guano, used to make phosphates. And it started to then take some of the proceeds from the sale of the bat guano so that it could create a fund to basically be available once the resource was depleted. Now, why have they become so visible today? Well, first, we have to take it into the context of a development in the market that has begun to shift dramatically the power of certain investors. There are 4 critical investors today that we're seeing in the markets: petrodollar investors, Asian central banks, hedge funds, and private equity funds. And they today have about 5% of all financial assets. And they often operate in common. Now, sovereign wealth funds are really a subset of the first 2 sets of investors. Petrodollar investors, that's basically commodity-driven, and Asian central banks. Now, one also has to put this in context today that this is the greatest transformation of wealth and economic activity since 2001. In China, the gross domestic product has grown plus or minus 12% higher than reported over the last 5 years. They are creating 1.5 million new jobs a year compared to the U.S., which since 2001 has lost 23% of the jobs in the manufacturing center. Commodities. Oil and gas will generate $4.5 trillion in revenues for those commodities producers. Half of that goes to 4 countries: Saudi Arabia, the United Arab Emirates, Kuwait, and Russia. That's about $2 billion. That is equal to the total earnings in the U.S., $2 trillion. As a consequence of this huge shift of wealth, sovereign wealth funds are now at $2 trillion, some estimate $2.5 trillion, will go to $5 by 2011 and $10 trillion by 2015. And there's no place for this money to go domestically that's held by countries that have this surplus. Take Abu Dhabi. Its sovereign wealth fund is close to $900 billion. It has 1.5 million people. The same with respect to Saudi Arabia. It gets close to $1 billion a year. It has only 87 publicly held companies. So these huge resources are held, and they must go outside. And this just tries to put them in perspective. So you can see that they're perhaps small today versus total equity market capitalization. But a couple of things to note. They are now larger than hedge funds. They're expected to grow, as I said, to $5 trillion by 2011, $10 trillion by 2016. Now compare this to what the IMF has. They have only $77 billion, and the World Bank has only $40 billion. So what you've got here is a situation where they're growing, but look at the size of the United Arab Emirates, a country I said of 1.5 million people, has 875, this is a bit outdated, it's a bit higher than that. And you can see that it's basically encroaching on the size of assets under management by some of the well-known asset managers. Now you have to look at sovereign wealth funds in the context of overall government activity. The classic government activity was when it had foreign reserves which it used to control monetary policy, and it was really managed mostly by the central bank, invested mostly in fixed income securities, typically in dollars, perhaps in sterling, other currencies as well. But as the reserves became more than was necessary to carry out government policy, they began to shift into other vehicles. One of the earliest was the sovereign stabilization funds. Now the classic example of that fund was in Russia. And the way it worked is that if oil were $20 a barrel or more, we only wish that were the case today, revenues go into the stabilization fund to be used in case oil drops below $20 a barrel, at which point it would be given back to the government to help deal with economic disruption. Now, because oil has tripled in the last 3 years, and because there's so much money in the Russian Stabilization Fund, they have taken some of that and shifted it into a sovereign savings fund. And that sovereign savings fund has just been created. Now, next to that are government investment corporations. They're slightly different. They invest in direct and possibly controlling domestic and foreign corporation assets. You may see them because they may, for example, want to develop the travel industry in a country like Indonesia or Thailand. So they will be investing more to generate domestic businesses that don't exist. But the most controversial are the affiliated corporate entities, Gazprom, the SABIC, which is a Saudi Arabian company. Now, if you remember when the Dubai Port Authority, it is an affiliated corporate entity, tried to buy Peninsula and Oriental Steamship Company. And what did they do? They ran ports in the eastern coast of the United States, Baltimore, New York. They had nothing to do with security, Peninsula and Oriental. They just scheduled the ships coming in, unloading, and going out. It led to a huge cry, and as we'll see, an amendment to one of our acts that restricts foreign investment. Secondly, you remember the China Oil Company wanted to buy Unocal in the United States. There was a huge outcry. because these companies are the ones that clearly are directly controlled by the government, will be carrying out government policy, and pose the biggest threat with respect to the countries in which they invest. And remember Gazprom, a country from Russia that 4 or 5 years ago was virtually bankrupt, is now the third largest company in the world. And given the tension between Russia and the United States, you can imagine the consequences if Gazprom tried to make a major investment in the U.S. This shows you what's funding the sovereign wealth fund. Look at the growth in global foreign reserves. Huge. Most of these are in dollars, euros, or yen. The domestic surpluses on the right are being funded from the United States on the left. Now here the implications for U.S. policy are as follows. If Asian central banks and or governments with these global foreign exchange reserves were to try to match the reserves from business they do with their trading partners, you would have a shift that would cause 1.9 trillion of U.S. Treasury securities to be sold in the market. And sovereign wealth funds, whereas the governments tended to invest in U.S. Treasury securities, fixed rate of return, sovereign wealth funds are shifting away from the U.S. And you'll find that whereas 60% typically of a central bank's reserves will be invested in dollars, only about 40% of sovereign wealth funds will be geared to the United States. The rest will be Europe, Africa, and elsewhere. So that again has a profound consequence for our economic policy, because the assumption is, since so many of these outside governments and funds have invested in the U.S., it's kept our interest rates down by about 55 basis points. Because the reserves are ballooning, you'll find that the funds are now developing more of a risk tolerance. The typical stabilization fund or central bank would invest mostly in cash and government bonds. Norwegian pension fund, we'll get to that, the most transparent, had shifted to fixed income and equity. But the ones in the Mideast especially are tending to be more aggressive. And more interestingly, they're prepared to pair up with private equity and hedge funds, as we'll see in a moment. You can see that with the subprime erosion, financial institutions were in desperate need of capital. Merrill Lynch, Morgan Stanley, UBS, Citibank, Bear Stearns, all reached out to sovereign wealth funds in the Mideast. They could make investments in size, they could respond quickly, but more importantly, they would take a long-term view, longer-term view than perhaps hedge funds or other pension fund investments. More importantly, they were prepared to be passive investors. And that was important. By passive, we mean that they would invest like any other investor like you or me in the market, would not insist on board seats, would not insist on being part of a group to affect management. Now, in addition to the direct investments in financial institutions, the China Investment Corporation initially invested $3 billion in Blackstone, which was a private equity company going public. The Singapore GIC company has announced that it's considering investing $2.5 in another famous private equity company called Texas Pacific Group. And China Investment Corporation is investing about $3 billion to $4 billion in J.C. Flowers and other funds. So you've got then the combination of investments backing by private equity companies, making them much more of a force in the market, and they take, again, a different perspective than the ordinary pension fund or mutual fund going forward. This is some of the investments that you'll see. I don't know whether many of you come to New York, but Barney's is now owned by a sovereign wealth fund. Madame Tussauds Wax Museum that you may go to in New York or London is also owned by a sovereign wealth fund. But it shows you the range of investments and the size of the investments that they're prepared to make. And as the funds grow, they will become the preferred investor of choice. In fact, Michael Klein made a very interesting observation to a presentation to one of our town halls. He said that you have to assume that given this massive shift away that 5% of all publicly held companies in Europe and the United States will have to be held by either sovereign wealth funds or government-related entities because they have no place to invest it other than existing and developed markets. There simply isn't room, given this huge wealth, in the emerging markets. Now, naturally, this has created some controversy. The benefits have been extolled, especially by those who have received the investment. They have a long-term investment horizon. They have low leverage, so that are not as much subject. By low leverage, they don't borrow as much as some of the hedge funds do to make their investment, so that they're more immune to the volatility of markets. And they may facilitate future investment in key emerging markets. Because this is one of the issues to keep in mind. With all this inflow into the United States, there isn't necessarily reciprocity with respect to outflow from the United States into, for example, China, into, for example, Indonesia, into, for example, Japan. And the question is, if we now allow this inflow, will we be able to open up the doors to investment in China, in Japan, and elsewhere, either through negotiated reciprocity or mandated reciprocity, and we'll come to that in terms of legislation. The threats. Most of these sovereign wealth funds, with the exception of Norway, are absolutely opaque. We don't know what they own. We don't know why they own it. We don't know what their guidelines are. We don't know what the government role is going to be. We don't know what they are investing solely for economic reasons, or whether there are some other reasons behind, some government reasons behind. And in a sense, most markets have moved away from government ownership. And now, in a situation, if you have both sovereign wealth funds or state-owned companies coming in to buy up key companies and key industries, is this a reversal of the move to privatization? So you may, in these countries, begin to see the political ambitions and the growth of sort of state-run companies and key industries. Market integrity concerns. Let me see. Oh, sorry. These came out of a speech that Chairman Cox of the SEC gave, because there is enormous focus here in the U.S. Secretary Paulson in October called a meeting of some of the key managers of 8 of the sovereign wealth funds to meet with representatives of the G7 to talk about some of the issues that were of concern of what we call host countries, the countries in which investments were made. There were hearings on February 13th in which key people testified, and because of the concern about some investments that have been made, which I will come to. One of the key things is enforcement. Let's assume that we are concerned that a sovereign wealth fund engaged in insider trading in the United States or manipulated some markets, and we wanted to take action against that fund. We would have to go to that fund's regulator, which again is government controlled, and will it be reasonable to expect that if the government made the investment, the government's prepared to cooperate with us in terms of investigating it? Secondly, and this came out of the congressional hearings, there's an aversion to government ownership in the United States on the theory that it really will distort market activity. And here we have just the opposite, because even though they're separately managed, it's government money and it's government controlled, and it would respond to government pressure. Competition by public entities may not be fair or may decrease confidence in markets. For example, if these companies have substantial investment positions, they may have access to information that other investors don't, and that could be problematic with respect to trading in the market. Concentration of power, especially in relatively lower paid civil servants, increases the possibility of corruption. Many of these funds are managed by government officials, poorly paid, and there may be some tremendous incentives to direct their investments to key industries or companies that really are in need of capital. Government investment may lead to inefficiencies. Governments have not historically been adept at pricing assets, and we're not sure that sovereign wealth funds will be any different. And they are concentrated in jurisdictions with a very weak rule of law. There's no doubt about that. They could increase volatility in that they were to take big positions and to unload them quickly, that could have a volatile effect on the markets. And their objectives and policies may not be transparent. There's one recent investment that has crystallized this issue, and it's a combination of a sovereign wealth fund, a state-owned bank, and a state-owned company. Billiton has made a takeover bid for Rio Tinto, which is a major tin company. The bid was about to expire. And what happened? A combination of the Chinese aluminum company, advised by the Chinese Sovereign Wealth Fund, financed by a state-owned bank, together with Alcoa, made a $14 billion investment in the target Rio Tinto. $13 billion from the Chinese aluminum company, $1 billion from Alcoa. Why? The largest investment ever by a Chinese company outside China. Now, is that because it was a great investment? Or was that designed to prevent the transaction from going forward? Why would China Aluminum Company be concerned? Well, because commodities are in such demand today, there may have been a concern that they would basically be locked out of access to what they needed to maintain a growing and vibrant aluminum company industry. Even though this bid was subject to antitrust review in Europe and Australia, it became a controversial investment, which will fuel the focus. What are the objectives and policies behind these funds, especially if they will act together with state-owned companies by investing in key industries going forward? Now, there is a framework to address these concerns in most emerging and developed countries. In the United States, we have something called Cepheus, Committee for Foreign Investment in the United States. It came out of the Exxon-Florio Amendment to the Defense Act of 1950. And there are similar restrictions, which I'll get to in other countries. But keep in mind when you think about these restrictions, and in terms of what I mentioned about politicization, most of the limitations are embodied in legislation which uses broad terms, undefined, such as national security, public order, public safety. It is enforced by government officials that have enormous discretion as to how they apply these concerns. And finally, because of that discretion and because of those broad concepts, it can generate political pressure to get a proposed investment to be vetoed, in part for reasons of protectionism perhaps, but because of perhaps real concern for public safety and security. The U.S. has a concept. Any foreign entity that wants to take control, not defined, that would threaten to impair national security, not defined, not exampled, has to go through a process of getting of notification to Cepheus. It doesn't have to notify Cepheus, but if it doesn't notify the Committee for Foreign Investment, then subsequently, after the fact, the government can step in and have the transaction being undone. Now, when I mentioned before the proposed acquisition by the Abu Dhabi Port Authority of Peninsula and Oriental, that went through the Cepheus process. It was notified to the government. It was not raised as any, and off it went. And it created an outroar in Congress. Hearings. Because there was a conflation of fear of terrorism, fear of safety, versus what the company actually did. The U.S. government maintained security in these ports, not Peninsula and Oriental. But there was an outcry. And the consequence of that outcry was that the act was amended, and three things happened. One is they began to specify what they meant by national security, to codify, in fact, a practice which had been developed by Cepheus over time. First, national security includes investments in companies leading to control in areas of critical technologies, not defined, critical infrastructure, think of the ports that were in the thing, and energy supplies. So that has been a situation. Secondly, if a foreign government is involved with respect to any acquisition in the United States leading to control, it must notify Cepheus, and there must be a 45-day review by the relevant committee. Now, for years, I'm just going to get some numbers here for the, give me a moment. Just to give you some background as to, for a while, this process really operated outside anyone's radar screen, because in 2006, of approximately 10,000 M&A transactions in the United States, only 1,700 were cross-border, of which 113 came before Cepheus. None were blocked. Cepheus has reviewed approximately 2,000 cases since inception in 1988, of which only a few have been blocked. And the only presidential divestiture occurred in 1998 in connection with the Chinese company's acquisition of a U.S. aircraft parts company. Now, that was fine. It was working quite smoothly. Most things came through. Then we had the Port Authority. We had the legislation being amended. And now we had something that was reported last week, which again shows you how politicized the process is coming and what our challenges are going to be. Bain, which is a private equity company, together with a partner, a Chinese private company called Huawei Technologies, made a bid to acquire 3M, which is a computer networking company, which has a division selling secret software to the U.S. government. The Chinese company, which is private, it is not owned by a wealth fund, it is not owned by the government, was going to take a 16% interest, have a board presentation, but Bain was going to run the company, and they offered to sell the division that had the contract selling secret software. And what happened? They pulled it. Why? Because they were told that Cepheus would not approve it. Again, it was a critical technology, supposedly, and notwithstanding that the investor was only 16%, 84% owned by the private equity company, they pulled it. That just suggests that these types of investments are going to be coming under increasing scrutiny, not just in the U.S., but in places like France, Japan, Germany, where all these countries have rules that do give the government the power to restrict foreign investment if certain broad interests are threatened, again, undefined. And the fear is going to be is where we've always advocated open markets, free flow of capital. There may be political pressure to shut that down, especially if the investment comes from China or Russia. If the Russian Sovereign Wealth Fund or Gazprom were to attempt to make an investment in Europe or the United States, I think it would lead to a great political contention. Now, there's a very important paper that will be presented to the EU this week, where the EU will try to lay out some guidelines dealing with investments into the EU from government entities, including sovereign wealth funds. The key is going to be to try to do a European-wide approach, try to limit the intrusion of states trying to pass their own rules going forward, maintain open markets, but as we'll come to, urge these entities investing to be more transparent and to come up with better principles of government. Now, in this regard, when Secretary Paulson called the managers of certain sovereign wealth funds together, he tried to start a process which we love in this country of voluntary compliance with best codes of practice. And the expectation was the International Monetary Fund would develop best codes of practices for the investing entities themselves, and the Organization of Economic and Development, the OECD, would develop guidelines as to how host countries should respond. Because what one worries about is a development of protectionism or perhaps a quid pro quo. You can't invest here unless we can invest there. Indeed, one of the reasons that Bain, for example, accepted the $3 billion investment from the China Investment Company was it thought that it would give Bain better access into China to conduct a financial business because the government may be more friendly given the fact that one of its investment vehicles had made a significant investment. Now, where these guidelines are going, we don't know. The IMF and OECD will hope to promulgate them sometime this spring. But the two areas that I mentioned that are being focused on are governance and transparency. And these are the areas that have been urged on the various vehicles to consider. Again, step back. Today, most are opaque. We don't know how they're run. We don't know what the role or interaction of the government is. And this idea is to, in a sense, separate these funds and make them look, act, talk, and walk as if they were a private investment and vehicle making traditional and normal private investment decisions. And as I said, there are some precedents that one can look to in this. I mentioned what the IMF and the OECD are considering. But the OECD itself has already developed some guidelines on the corporate governance of state-owned enterprises such as Gazprom. Not that these practices have been implemented or necessarily acknowledged, but there is a framework on which we think the IMF will build as it develops practices for the investment vehicles. And the IMF has also developed guidelines for foreign exchange reserve management, which may be relevant going forward. But this is the area that's attracted the most attention, and that is transparency, because there's so little information. And the idea would be to have something comparable to perhaps an annual report that would be published. We would set out the objectives of the fund, the source and uses of funds, how investment decisions were made, how disinvestment decisions were made. We'd have reporting of the investment allocation, practices, policy as to how they would exercise ownership rights, who managed, the results they achieved, size of the fund, and conditions for portfolio adjustment. Senator Schumer, in the hearings last week, said he would ask the following 6 questions to the sovereign wealth funds, and if he didn't get a positive answer, you can understand what his response might likely be, because it is absolutely clear that the U.S. is considering legislation in addition to what we have today with respect to Cepheus. He would ask the following questions: whether sovereign wealth officials report to the government or an independent board, whether the sovereign wealth fund makes public its investment goals, whether the sovereign wealth directors and managers are selected on merit rather than political affiliation, if the sovereign wealth fund has a code of conduct that compels management to report attempts of government interference in its investment decisions. That is, that the government direct the fund to take action in any case. Whether the sovereign wealth fund provides audited financial statements, and whether the sovereign wealth fund publicizes a list of its portfolio investments. Again, I think this is just a fear and a concern in the context of this huge shift of wealth I have described. To give another statistic that came out at our town hall, in 1990, the non-democratic countries had only about 10% of the GDP of the democracies. That's now 60%. And we are going to face a situation in which the global economic power of non-democracies is equal to those of democracies. We've always assumed that democracy was necessary for economic growth and the development of mature capitalism. That's no longer the case. China is a classic example. Russia may be as well. So we have a situation where huge wealth will be controlled by non-democratic countries who will have funds that can make investments into the developed world, and it will be a challenge to be sure that we keep markets open, we keep investment flows going, but that we be sure that there's appropriate transparency, appropriate governance, and appropriate control of some of our critical industries going forward. It would be inconceivable today for us to allow control of major energy resources to be owned outside. On the other hand, we're the host country. We have control of those assets, even though they are foreign owned. Remember, Citgo is wholly owned by the Venezuelan government. That's gone fine, and if we're not happy with what the Venezuelan government will do, there are steps we perhaps can take. So what are the key takeaways before questions? They're big, getting bigger fast, and no one expects that the price of oil is going to basically drop materially soon. They're not all equal. On the one hand, you have fund which is probably the most admired in the world, and that's Norway, because it is public, it is transparent, it has socially minded investment criteria. It won't invest, for example, in companies that make landmines and other types of activities, and it's very open and public, versus the Abu Dhabi Investment Authority, which is the most opaque. Some concerns focus on national security and market integrity, but here the problem is there's a confusion between the role of sovereign wealth funds and state-owned entities. And we've got to be sure in the context of this debate that that line is kept separate, because it is one thing to have Gazprom or the China Oil Company be investor. It's another thing to have the China Investment Corporation, the sovereign wealth fund, be an investor, especially if it's independently managed, more transparent, takes positions that aren't controlling positions, and is welcomed by the companies in which it invests. There are probably modest steps that ought to be taken, including increased disclosure and agreement on principles of government. But the difficulty is there may be some arrogance that prevents that, and we will have to watch out for the economic fallout. For the first time in its history, Davos, the World Economic Forum, had a session on sovereign wealth funds. And the new director of the Russian sovereign wealth fund that had been spun off from the stabilization fund was asked about having codes of governance and transparency. He said, why do we need it? We have been investing like others in the market for years. Companies are perfectly happy to welcome us in. We will run our entities the way we are required to do under local law. There's no need for us to embrace what is, in a sense, a politically driven process in which you want us to basically adopt these transparency and governance procedures. Well, if we have that type of attitude in all the sovereign wealth funds, I do fear we're going to have a political backlash, which may, in a sense, be more detrimental to our markets than helpful to our infrastructure or perception of national security. But it's an issue that's here to stay. There are hearings that are again going to be scheduled in Congress, and it's something to follow, especially because the amount of money at stake is enormous. And with that, Jim, I will take any questions.
Well, I'll lead off with the first question here, and I was wondering, does this debate actually get even more complicated, and does it run the risk of being complicated by being sidetracked, perhaps, by the sort of neuroses we saw in this country in the early 80s when the Japanese economy was expanding rapidly and they were buying our icons from Pebble Beach to Rockefeller Center, et cetera, and there was a great hue and cry about our vanishing cultural icons, as well as whether we were all going to be ultimately driving Toyotas. So I'm wondering if that's going to
I think that's
the debate.
And that's just not here. I suspect that's going to be the reaction in Europe as well. There was a proposed investment by Sistema, for example, which is a Russian mobile telecom company in the great crown jewel of Germany, Deutsche Telekom. They wanted to buy 10%, and Prime Minister Merkel went ballistic and forced that investment to not be made. So I think the difficulty is there are political agendas here, and for the Congress, it's going to be very hard to be critical if they're complaining about a Russian entity investing in the United States or something from China. I think ironically, it's the Mideast that probably will escape this, though at the same time, that's our biggest concern politically with respect to, for example, money laundering and other activities that may fund terrorism. But because the countries are so small, the vehicles really can't have much of an impact, and they ultimately will probably be more interested in developing domestic interests. It's the large countries, China, Russia, India, that are the ones that will generate, in my view, the most political reaction. Yes?
I saw a substantial investment of sovereign funds into the Caribbean, particularly in resource, fisheries, ports, banks, financial institutions. It created a substantial concern amongst small governments. Are we seeing a sensitivity in the United States to purchase of forests, production of food, production of financial resources such as banks?
Well, I think with respect to banks, we had one protection, and that is any purchase of over 5% of a U.S. financial institution, if it were a holding company and a bank, would have to be approved by the Federal Reserve Board. And the Federal Reserve Board would not approve control by a foreign entity of a U.S. financial institution. U.S. broker-dealers are different. And probably U.S. brokers could be taken over and owned by foreign companies. And for example, as we acquired a Japanese broker-dealer, a Japanese broker-dealer could acquire U.S. But so far, funds have been sensitive to that and have limited their investments to passive non-control. Morgan Stanley was the case in Merrill Lynch. Food, I haven't seen so much. But most countries, the key areas that they will worry about will be financial institutions, infrastructure, and technology, and probably energy. And those areas will get a great deal of scrutiny because of fear that, in a sense, you'll have dependence upon foreign companies, foreign supplies, and that's just not today accepted. That will be interesting given the commodity growth in prices. And it's not just oil and gas, but it's tin, zinc, now wheat and others, as to whether there will be increasing concern if control of those commodities is basically located outside the host country, especially if you've got significant supplies of that in your own country. It's a fair point. You had a question back there, sir?
Yes, sir. There seems to be a sense that these sovereign wealth funds will not act like rational investors and will be motivated by political ambitions. I'm curious if there's a sense that maybe these sovereign wealth funds will actually cause countries to act more rational and responsible, in their own policy because they'll be more dependent upon a well-run, efficient global economy. And if there's any sort of basis for that.
That's a very, very good question. Ted Truman, who had been at the Fed and the Treasury, who's now with the Peterson Institute, gave some testimony before the Congress. And his point was that result could be achieved if the funds were more transparent and better governed, because they would then function more like other investment vehicles throughout the world and would provide the kind of stability you want. It's a fair point. And also, a lot of it may be exaggerated to date in terms of what their ambitions are, because as I said, the classic case was where this Chinese company was not even a sovereign wealth fund, was coming in, and only a 16% investor, but it was pulled because it was thought that Cepheus would not approve it. Just showing you today that in certain types of investments, in certain infrastructures and technologies, governments are basically not going to permit almost any foreign investment because this investment was in no way controlling. So it's going to be interesting to see what happens. I mean, what would happen, for example, if someone wanted to buy a significant stake in Microsoft to help it fund a Yahoo acquisition? I think it would be quite interesting. Yes?
What's the mechanism by which this is policed now? If a Chinese company were to make an offer for Microsoft, it would require government approval just under this statute?
I think it would have to two things. You'd have to. It would have a choice. If it were a government-controlled entity, it would be required to file with Cepheus, and there would be a required 40-day investigation. If it were just a foreign entity that was not government-controlled, it would have a choice. And if it decided not to file, it would not be immune, because if it would come to the attention of the committee or the president, it could be forced to divest. The reality is most of these investments today, for prudent reasons, are notified to Cepheus. For example, the investments made in the financial institutions, even though they clearly were not controlled, and they couldn't be controlled because of the Federal Reserve Board requiring approval over 5%, they were all notified to Cepheus, just to, in a sense, show that we're going through the process, we're sensitive to the issues of foreign investment in the United States, and all went through in the ordinary course. The reason that sovereign wealth funds are attractive investors is that if you have to raise $12 billion very quickly and privately, because if you try to raise money publicly in your financial institution and it doesn't go successfully or it fails, you could really create a run on the bank. And so what you want to do is to be able to go to a discrete investor, have a quick investment decision made, and announce it publicly. And that's what we did. In 2 tranches, we raised $35 billion in about 2 weeks, because they knew the institution, they were interested in diversifying, they were prepared to take a long-term view, and they had substantial resources. So that, to me, is a positive to the market. It was a positive to us. Now, what if it had been not a financial institution, but another entity involved in technology or infrastructure? Would there have been the same response? And there are 2 things one worries about. Could there be collusion between comparable investors to decide how they would control or direct the company? Secondly, would there be a motivation through the size of the investment to have access to technology that it could shift back to the home country to give benefit to the local industry? Those are the concerns that have been expressed. Yes?
Is there a sense that the market treats differently, or just for the fears that you're raising, for a foreign investor to invest through a U.S. intermediary like a fund operated by Blackstone, as opposed to investing directly in a corporation?
That's a fair point. I think that's one of the
Or your
reasons.
corporation?
I think one of the reasons that some of the wealth funds are coming in indirectly through the private equity funds like Blackstone, Carlyle, and Texas Pacific is to give them opportunities, but the shield of a U.S. company that really won't attract Cepheus review, because the control would be exercised by the TPG or the Blackstones or the Carlyles, and that in turn, you know that those entities won't permit or tolerate control by a sovereign wealth fund coming in. But that's a fair point, what is beginning to happen. Also, it gives them a bit more leverage in terms of the size of the investments they can make. And for the private equity firms, this is a great source in their view, because again, they tend to be long-term investors. If they have confidence in the management, they're prepared to probably be a bit more passive than perhaps U.S. investors might be.
Thank you, Ed. This was great.
Thank you.
Thanks, everybody.